Hi friends, hope your preparation is going on well for the AFM subject. In today's video, I'm going to discuss a concept which is there in the security valuation topic. Some requests have come from few of you to explain this concept, which is called Global Depository Receipt. It is covered in the ICI material, and there is one problem which is also discussed. So first, I'll discuss what does this concept of GDR all about. Now, let's understand this with little bit of practical understanding. Let's take an example of Infosys. The product name is we are discussing is Global Depository Receipt. Few other places it is also called as American Depository Receipt. If it's issued in USA, it is called American Depository Receipt. And if it's issued in any other country, it is called Global Depository Receipt. Let's first understand what does this product all about. Now, Infosys is in need of funds. So I want to raise 1,000 crore. So I am planning to make an issue in India and raise 1,000 crore rupees, which I will get it, That is happening. But now I also want some foreign investors to invest in my company. Or I'm trying to raise money in India, but I don't find investors. So I want foreign investments. So I talk to some investor in USA. I tell them that can you invest in my company? I tell these investors, can you invest in my company? Infosys issues its equity share because it wants to raise an equity shares in INR currency. The equity shares are priced in INR currency. So Infosys is saying these investors in USA, can you please invest in my company? These investors are saying we are ready to invest. We are ready to invest, but we will give only in US dollar. We don't want this headache of converting our investments into INR and then make investments in Infosys. Or I don't want to take money from USA, deposit in some bank in India, and then make the investments from Indian market. So they are saying we are not ready to do all this. But now Infosys wants funds. USA investor is ready to invest. The only headache is the currency because US guys are ready to invest only in US dollar currency, whereas Infosys can issue its equity shares in India only in INR currency. So we are kind of a stuck situation. One guy says INR, the other guy is saying it has to be US dollar, and I need something in between here to sort out this problem. No hedging, nothing, all that is not going to work, but I need something so that I sort out this problem which I am facing. Problem is unique for me. The unique problem I am facing is that guy is saying US investment, I am saying I need INR. So how do I sort out this problem? So here comes the product called ADR or GDR. You can give both are same, ADR or GDR. ADR is called American Depository Receipt and GDR is called Global Depository Receipt. What will happen here is Infosys will deposit 10 lakh shares to a custodian. I'll deposit 10 lakh shares to a custodian. Against this deposit of share, that is my shares, instead of issuing it in the market, I give it to a custodian, and this custodian or a depository participant bank will issue against the security of this 1 lakh GDR or ADR. Both are same only. GDR is from any country other than USA and ADR is from US point of view. Now indirectly 10 lakh shares is equal to 1 lakh GDR. 10 lakh shares is equal to 1 lakh GDR. There will be a ratio. It can be 10 is to 1, 4 is to 1, 3 is to 1, 2 is to 1. Today the share price is 1,000 rupees. This is the price in the market. It is a listed product. The price in the market is 1,000 rupees, which means price of a GDR, issue price of a GDR is 1000 into 10. What is 10? 10 lakh shares converted into 1 lakh GDR. So one share is, sorry, one GDR is equal to 10 share. One GDR is equal to 10 shares. So price of a GDR is rupees 10,000, which is again of no use. I'll convert this into dollars and make the issue in dollar currency. So what will happen here? I'm in need of 1,000 crore rupees. I'm in need of 1,000 crore rupees. I can issue only in INR. So what I do, I deposit 10 lakh shares. I deposit 10 lakh shares. These 10 lakh shares into 1,000 rupees, into 1,000 rupees will give me maybe 1,000 crore, less than 1,000. I'm not bothered about those numbers. Okay. 10 lakh shares will give me this money which I'm in need. The current market price is 1,000 rupees. The current market price is 1,000 rupees. I deposit this with the custodian. I deposit this with the custodian. What does the custodian do? The custodian is saying, I will take this 10 lakh shares. Against this, I'm going to issue 1 lakh GDR or ADR to your foreign investor. To the foreign investor. The foreign investor will get 1 lakh GDR or ADR at what rate? 10,000 rupees. No. Let's assume exchange rate is 100 for imaginary sake. So the issue price is 10,000 by 100 dollars. The issue price of one GDR, the issue price of one GDR is $100. The issue price of one GDR is $100. This is the example. This is the example. Infosys is in need of money. Ignore the amount. I have equity which is an INR. I deposit shares with the custodian. The custodian is going to issue. The custodian or the depository participant is going to issue shares. Is going to issue shares. 1 lakh is going to issue ADR or GDR, which is, can be 1 lakh or 10 lakh, whatever be the number. It can be 1:1 mix. It can be 2:1, 3:1. Then I'll explain with a practical problem which is tested in exam. So 10 lakh became 1 lakh GDR, and I'm going to issue this as 100. Question may say that I want to give some discount. Instead of issuing it $100, I may issue it at $80, $90 to make it attractive. To make it attractive. This is one part of the calculation. What is the formula for cost of GDR? KGDR is equal to D1 by P naught minus F plus growth rate. Cost of equity formula, D1 by P naught minus F is flotation cost. In case any flotation cost is there, this is the formula for cost of equity, not cost of GDR. The D1 will be for 10 shares, P naught will be for 10 shares, flotation cost will be for 10 share, and growth rate will be as it is. We are going to do calculation for 10 shares. We are going to do calculation for 10 share. Why 10 share? Because 10 shares is equal to 1 GDR. 10 shares is equal to 1 GDR. Again, the concept one more time. Infosys is in need of funds, or let's read it here. A global depository receipt is a financial instrument issued by a foreign depository bank representing shares of a company like Infosys. It allows investors to trade shares in international market, without what? Direct ownership of the share. I don't hold shares, but I hold GDR. Why should I do global trade? I want trade to happen in USA. I want trade to happen in UK. Companies deposit shares with a custodian bank, which issues GDRs traded in foreign market, Each GDR represents a number of underlying share. What can be the number? 10:1, 3:1, 2:1, 5:1. Investors will receive dividend, capital gains in the currency of the GDR. So it facilitates cross-border investing without the need for direct share trading in India. In India, they need not. So the US investors don't want to come to India, don't want the Indian regulations to impact them, RBI condition, tax issues, all that I don't want. Cost of GDR is similar to cost of equity. GDRs are backed by underlying shares. Dividend per GDR can be determined. Flotation cost will be there. So P naught in the formula is replaced with P naught minus F. So K is technically equal to D1 by P naught minus F plus growth rate. This is on the instrument. Now I'm going to do a problem to understand the concept, but the instrument is very simple. Now just a practical angle. This is the share price graph of Infosys. This is the share price graph of Infosys, which is listed in India. 1 year graph. 1 year graph. Similarly, there's an ADR. ADR, Infosys Limited ADR, which is again, I'll put a 1 year graph. I'll put a 1 year graph, and both the graph will look same. Both the graph will look same. ADR is listed in USA, American Depository Receipt, listed in USA. Trade will happen in USA for this, and here trade will happen in India. Both the graphs are exactly similar. Exactly similar. This is $21. This is 1808 rupees, maybe 1 is to 1. It could be 1 is to 1. One share is equal to one ADR, 1808 in India, and around $21. $21, which if you multiply with 80, 83, or 84, you may get the same rate. You may end up getting the same rate. So here the ADR product, is exactly same as equity share. Only thing is ADR or GDR is in not INR. It can be in GBP, it can be in USD, it can be in Japanese yen, it can be any currency. It can be any currency. Infosys ADR listed in USA graph, and Infosys Limited listed in India graph, both are same. Both are exactly same. No change at all in the graph. No change at all in the graph. This is one point which I wanted to show with the practical example, so that you appreciate this product. So that you appreciate this product. Now let's do the problem which is there. I'll quickly discuss. Problem is not my major worry. That's a quick discussion. Odessa Limited has proposed to expand its operation, for which it requires funds of 15 million net of issue expenses, which amount to 2% of the issue size. So I want to raise $15 million, and there is an issue expenses of 2%. I want to raise this funds through a global depository receipt. Following data: domestic price of the share is 300. Three shares underlie each GDR. Three shares underlie each GDR. So one GDR is equal to three share. So technically one GDR, I'll keep explaining as I read it. 3 into 300. One GDR is 900 rupees. One GDR is 900 rupees. And then they're saying underlying shares are priced at 10% discount. Why 10% discount? To make it attractive. To make it attractive. So one GDR is now 900 minus 10% rupees 810. Doesn't end here. Then the exchange rate. This is important because it will be issued. It will be issued in foreign currency. It is going to be issued only in foreign currency. I am not going to issue this in Indian currency. So my issue price is going to be 810. 810. So current market price of share is 300. One GDR is equal to 3 shares. Issue price of GDR is 3 into 300 rupees 900. But then they are saying no, we don't want to issue it at 900. We want to give discount. We want to give discount minus 10% discount, rupees 810, rupees 810, and ultimately issue price is equal to, with this I think the problem is almost over for me, 810 by 60 USD 13.5. This is the issue price of a GDR. How much money I want to raise? I want to raise 15 million with an issue expenses of 2%. Compute the number of GDRs to be issued. Cost of GDR, if 20% dividend with a growth rate of 20%. What is your suggestion? If you can take a loan, if you can take a loan at the interest rate of 12%, I'll explain this as we proceed. And how much company can save? How much company can save by choosing the option as recommended? My main focus is part 1, number of GDR and cost of GDR. Number of GDR is 15 million. Considering the issue expenses, I have to raise more money. See, I need net amount 15 million. So it's like this: gross less expenses net. Gross is 100, expenses 2, net is 98. Gross is 100, expenses is 2%. 2%, net is 98. I need net 15 million, 1 crore 50 lakh. What is 100? We have to see. I need 1 crore 50 lakh, 15 million. 1 million is 10 lakh. 1 crore 50 lakh dollars. 1 crore 50 lakh dollars. So how much money do I raise? So again, gross is 100, expenses to net is 98. 98 is equal to 1 crore 50 lakh. What is 100? What is 100? So amount to be raised 1 crore 50 lakh divided by 98 into 100, cross multiplication. I have to raise 1 crore 53 lakh. In this 2% expense, if you remove, you will get 1 crore 50. You will get 1 crore 50. That is from here. If I subtract 2% expense and 98%, I get 1 crore 50. Gross amount to be raised is 1 crore. Amount to be raised is 1 crore 53 lakh. 1 crore 53 lakh is the gross amount to be raised. Now, in this gross amount, I know the issue price. The issue price is calculated here. I said 1 GDR 300 rupees. 1 share is 300. 1 GDR is 3 share, 900 rupees. 10% discount, 810. Issue price. Issue price. There is flotation cost, which we'll see later. Issue price of GDR USD 13.5. Number of GDR is this divided by 13.5. This divided by 13.5. I have to raise 11 lakh 33,787 GDR. 11,33,787 GDR. This is the number of GDRs to be issued. Part 1 of the question. Part 1 wanted number of GDRs to be issued 11 lakh 33,787. I have told it is like not 11,33,787. It is like this. You are going to indirectly issue into 3. Some 34 lakh shares. Some 34 lakh shares will be indirectly deposited and we will issue 11,33,787 GDR. This is one part. Second part is cost of GDR. Cost of GDR is equal to D1 by P naught minus F plus growth rate. Now, what is D1? 20% dividend they have given. So 20% dividend is on face value. Problem is silent. Face value, I take it as 10 rupees. Face value, dividend is paid on face value. So dividend per share is 2 rupees. And per GDR is 2 into 3. Dividend per share is 2 rupees and per GDR. So dividend is 2 rupees into 3. 2 rupees into 3 shares into 3 shares. What is the issue price of a GDR? This is in INR. I'll show it in dollars in some time. 8, 10, 8, 10. Everything is in INR. And what is minus F? Flotation cost. What is flotation cost? 2% of the issue size. 2% of the issue size. Flotation cost is 2% of 810. 2% of 810. 16.2. Growth rate is 0.20. 20%. Growth rate is 20%. 0.20. So this number now is 6 divided by 193.8. 0.0076. 0.0076. We are kind of done. 0.0076 plus 0.20 equal to 0.2076 or 20.76%. 20.76%. 20.76%. Very simple calculation. 20.76%. This is the cost of GDR. This is the cost of GDR. The cost of GDR is what? 20.76%. This is one part of the calculation, the cost of GDR. I could have done this entire calculation in dollars, where the numerator would have been divided by 60, denominator also by 60. That is 2 into 3, 6 rupees. 60 is the exchange rate. So this is USD 0.1, 6 divided by 60, 6 divided by 60, 6 divided by 60. Denominator is 13.5, that issue price, minus 2% is 0.27, plus 0.20, same answer you will get. So cost of GDR is 20.76%. Cost of GDR is 20.76%. If I can get a loan at 12%, I'll be very happy to take a loan. Why do I have to get into a 20.76% GDR cost? I will take a loan at the rate of 12% and save how much? 8.76% for the company. Take a loan at 12%. Yes, I recommend. I recommend taking a loan at 12 percentage and save how much? 8.76 percentage. What is 8.20.76 minus 12? So 20.76. We can convert dividend as well as net proceeds in USD and do the calculation. Answer will remain same. If you can take a loan at the rate of 12%, please take it and save 8.76% for the company. This problem is there in my concept book and question bank. So the concept, everything is there in my concept book and question bank. Please keep reading with my concept book. Very useful. Many students have got benefited with the concept book, where you can revise all the concepts very fast with certain MCQ example. So I have done this concept based on your request. Any other concept you want my help, or any problem you want me to solve, do comment in the chat box, do comment in the video. I'll try to record extra videos or for any concept or a specific problem wherever feasible from my side. Thank you, friends.